On 1st February 2023, the Finance Minister presented the Union Budget. We present our analysis of the budget. As expected, the budget had a mild undertone of populist budget, along with measures to continue the growth of the economy. The budget was presented against the backdrop of global monetary tightening, a large fiscal deficit, and a large current account deficit, and hence fiscal consolidation was obviously needed. The budget lived up to the expectation by maintaining a fine balance between fiscal consolidation and capex push. The budget took measures to increase the income in the hands of the investors by simplifying the personal tax structure. It gave relief on indirect taxes and brought about structural reforms. The key highlight was allocation of Rs 10,000 billion for capital expenditure that ascertained the government's priority to continue pushing the investment cycle. Better than expected tax collections helped to meet its fiscal deficit target comfortably at 6.4% for FY23, with a 5.9% target for FY24 and 4.5% by FY26. This makes fiscal math slightly optimistic but achievable. The decrease in borrowings estimate at Rs 11.8 trillion in FY24 would allay bond market concerns and softening of yields. Although tax changes would improve the urban consumption, a reduction in allocation of rural spending would offset this advantage. Further, no tinkering with the LTCG tax brought relief to investors' anxiety. The aforesaid measures would provide a boost to corporate earnings, thereby providing much needed boost for the capital markets. The budget was largely positive for several sectors such as infrastructure, banking, consumer discretionary, auto, capital goods, oil and gas, IT, pharma, defense, power, healthcare, metal and mining, and telecom. However, real estate and insurance were largely negatively impacted by the budget. Having understood the gist of the budget, now let's dwell a bit deeper into the budget to understand it better. Fiscal math. The budget estimates a growth of 11.7% in tax revenue receipts to Rs 23,306 billion in 2023-24 over 2022-23, and non-tax revenue is estimated to go up by 15.2% to Rs 3,016.5 billion, and there is an increase of 11.5% in the share of states in the revenue to Rs 10,214.5 billion. The total expenditure has been estimated to reach Rs 45,030.9 billion, a growth of 7.5%, fueled by a gross capital expenditure of 10,000 billion, a growth of 37.4%. The internal and external budgetary resources increased by 43%. Fertilizer subsidy is estimated to go down by 22.2% and food subsidy down by 31.3% in 2023-24. Some subsidy burden has been shifted to Food Corporation of India. The fiscal deficit is estimated to be 5.9% of GDP in 2023-24, reaching a fiscal deficit below 4.5% in 2025-26. Some of the key direct tax simplifications include the following. The income limit for a rebate of income tax increased from Rs 5 lakhs to Rs 7 lakhs in the new tax regime. Reduction in the highest surcharge rate from 37% to 25% is available in the new tax regime now. It would result in a reduction of maximum tax rate to 39%. The limit of Rs 3 lakh for tax exemption on leave encashment on the retirement of non-government salaried employees has been increased to 25 lakhs. Standard deduction of Rs 50,000 to salaried employees and deductions from family pensions up to Rs 15,000 now extended to new tax regime. The turnover limit for benefit of presumptive taxation has been increased to Rs 3 crore and Rs 75 lakhs for MSMEs and professionals respectively, whose cash receipts are not more than 5% of turnover. The budget 2023-24 proposes to allow carry forward of accumulated losses and unabsorbed depreciation allowance in the case of amalgamation of one or more banking companies with any other banking institution or a company subsequent to strategic disinvestment if such amalgamation takes place within 5 years of strategic disinvestment. Income from market-linked debentures is proposed to be taxed at short-term capital gains tax at the applicable rates. The tax collected at source has been increased from 5% to 20% for foreign remittances other than for educational and medical treatment under the LRS and purchase of overseas tour programs. Income received from business trusts by the manner of repayment of debt to unit holders will be taxable with effect from 1st of April 2024. It was earlier exempted. Further, the government simplified customs duty to deliver higher exports, higher domestic manufacturing, more value addition to the economy, and green energy mobility. We now discuss the key sectors that are benefited from the budget. The budget was largely positive for infrastructure, cement, metals and mining, and building materials on the back of the following initiatives. Allocation of Rs 10,000 billion for capital expenditure. Continuation of 50-year interest-free loan to state governments to incentivize infrastructure investment with an increased outlay of Rs 1.3 lakh crore. Increase in outlay for MORTH and for NHAI. Pradhan Mantri Gram Sadak Yojana outlay for FY24 kept flat at Rs 19,000 crore compared to FY23 budgeted estimate and FY23 revised estimate. Jal Jeevan Mission outlay for FY24 increased by 17% and 27% versus FY23 budget estimated and FY23 revised estimated at Rs 70,000 crore. Allocation towards smart cities increased by 3% and 5.4% to Rs 6,800 crore vis-a-vis FY22 revised estimate and FY22 budgeted estimate. Establishment of Urban Infrastructure Development Fund to create urban infrastructure in Tier 2 and Tier 3 cities, providing Rs 10,000 crore per annum. The budget is also positive for capital goods, defense, and consumer electronics. Key measures include a strong outlay of Rs 2.41 lakh crore for railways and metro projects at Rs 19,518 crores. Allocation to the Ministry of Defence at Rs 5.94 lakh crore versus Rs 5.25 lakh crore in FY22-23. Lesser than expected increase to Air Force impacted companies like HAL and Bharat Dynamics. The interstate transmission system for 13 gigawatt renewable energy from Ladakh with an investment of Rs 20,700 crore. Reduction in customs duty on parts of open cells of TV panels to 2.5% from 5%. A duty of 2.5% was reduced to nil for camera module parts of mobile phones. The budget is positive for oil and gas sector. Key measures include FY24 capital budgetary support of Rs 30,000 crore for the oil marketing companies. Priority capital investments of Rs 35,000 crores towards energy transition and net zero target. Investment of Rs 10,000 crore for setting up CBG plants. The budget is also positive for the power sector. Key measures include viability gap funding, support for battery energy storage systems, green hydrogen production target of 5 MMT by 2030. The budget is positive for automobiles. Key measures include increased customs duty on imported vehicles and exempted customs duty on specific machinery required for manufacturing of lithium-ion cells. Budget is positive for consumer discretionary. The tax rate on cigarette was increased by 2%, which is only a marginal increase. Consumer sentiment would be boosted by providing tax benefits and allocation under various rural schemes. Increased focus on domestic tourism with launch of various programs. The budget is also positive for financial sector. Key measures include Rs 9,000 crore allocation for credit guarantee scheme for MSMEs for additional collateral-free guarantee scheme of Rs 2 lakh crores for MSMEs. Special measures to promote business in GIFT IFSC. Enhanced maximum deposit for senior citizen savings scheme from Rs 15 lakh to Rs 30 lakh. One-time small savings scheme for a 2-year period with a deposit of up to 2 lakh for women. The budget was negative for insurance and real estate sector on back of the following measures. Income from insurance policies where premium is over 5 lakh will not be exempt from tax. Capping of deductions available for capital gains on investment in residential houses under Section 54 and 54F where the cost of new asset does not exceed Rs 10 crore. The income received from business trusts by the manner of repayment of debt to unit holders will be taxable with effect from April 1, 2024, which was earlier exempted. This would adversely impact REITs and InvITs. Although the government has managed to pull off a good budget, which will provide a boost to the earnings. Weak exports and slow domestic demand will offset the benefit. The market currently continues to remain range-bound and valuations are fair. Investors with a long-term horizon should continue to stay invested in the market with a hopeful recovery in FY24. This is Shah signing off. Happy investing. This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing. Thank you.